Ladies and gentlemen, the webinar is beginning. Welcome. My name is Chris Wilson, Communications Director here at the Dallas-Fort Worth Hospital Council. Thank you for being here today for this webinar, hosted in coordination with Mercer, an associate member of the Council. Today's topic is Enterprise Risk Modeling for Healthcare Systems. We have an expert speaker to discuss a powerful tool to assist healthcare systems in the allocation of capital resources. Our speaker today is Chris Grimm, Principal and Senior Investment Consultant at Mercer. He is the co-lead of Pavilion, Mercer's not-for-profit healthcare segment, which offers an investment consulting approach that integrates an entity's variety of investment pools into an analytical framework for risk management. Prior to his acquisition by Mercer in 2018, Chris was with the Pavilion Advisory Group and Jeffrey Slocum for 11 years. We're looking forward to his presentation. So, ladies and gentlemen, please welcome Chris Grimm.
Chris, thank you for that introduction. Good afternoon, everybody. Thank you for your time. I hope you find this interesting. I think especially after recent market events, we had a pretty tumultuous fourth quarter, a really pretty nice rebound the first 6 months, and now looking forward, things look a little more uncertain. I'll skip over my bio page and just get right to what I want to cover today. And please filter questions along the way through Chris. I think you can type those out and happy to address those. I wanted to just start with trends, and I realize I'm not in the healthcare delivery business, but I'll look at the trends from my point of view as an investment consultant, kind of where we're at in terms of the challenges. Give a description of the process. We call it our CARE model. That's a Pavilion, a Mercer Practices enterprise risk process. I'll give it kind of a high level of what considerations we take into account. And then where I do want to spend the majority of our time is just in a sample health system case study. I tried to combine, create a composite fake health system using some real issues that some of my clients are facing today and try to make it so it's disguised in terms of information content. So in terms of the trends, no surprise to anyone here, and this is, it does serve a purpose, not just to make everyone sad, but the fact that margins are under pressure, both the operating cash flow as well as overall operating margins, and how this affects my job and how we work with clients. One is just the rating agencies, how they view this and potential downgrades, but more to the point of investments, lower margins is less excess cash flow to be able to be invested. 12 years ago, I worked with a number of systems that it seemed like year after year, they had a check for $25, $50 million they were putting in their long-term portfolio annually. Today, that's scarce. If anything, we've seen some outflows from operating pools from time to time to cover operations and capital spending. So less money to be invested in the portfolio. And then another part of the margins is just the increasing costs, specifically increasing cash expenses has driven up the cash burn rate and putting pressure on days cash on hand, probably the most commonly cited ratio from an investment perspective. So that's really what this chart here captures. I think despite the fact that, and these are Moody's medians from 2017, or 2018 report, I should say, despite the fact that the median unrestricted cash in investments has grown 22% cumulatively in the last 5 years, days cash on hand has declined 6% in the last 5 years. So again, increasing cash balances, but the increase in cash expenses has pushed the days cash on hand down further. You look at this 5-year period, a couple good years in the market. 2015 was challenged, and then as we know, 2018 was difficult as well. As we think about, how hospital systems should invest their operating pool, and we'll talk about other portfolios a little bit later on. A couple things just looking at from a fundamental perspective in actual businesses, very different payer mix across the range. So these are just, this is from the 2018 Moody's report looking at the freestanding hospitals in single state systems the low, median, and high for payer mix in terms of Medicare, Medicaid, commercial, and self-pay. And clearly a very large difference between a system that's got 3.7% in Medicaid versus 45% in Medicaid in terms of margin generation. Similarly, you can see that range in commercial payers ranging from about 6% to 54%. It's not just the revenue and the payer mix side. You just see this enormous variance across various financial metrics. So, we see some systems running a negative operating cash flow margin, others close to 20%. The days cash on hand range across the Moody's universe, little over 60 days to 670 days. And down the list, just very different financial health across systems. And it really, the question it begs is, how do you invest? How do you position your portfolio? What's the appropriate amount of risk to take? And what should really be key concerns? I think the challenge for any health system or any investor, I should say, trying to, generate a higher return, something in the high single digits or even mid single digits in this environment, is you need to have a long-term outlook. If we look back to the tech bubble in the early 2000s, we look at the great financial crisis, these pretty significant drawdowns, and even 2018, global stocks down 9%. All followed by a pretty strong recovery. And the message here is, again, if you're going to be in a significant portion of equities, the last thing you want to do is to have to de-risk at an inopportune time. And I think we've all seen, whether it's, seen clients have to do that, other players in the industry, individuals have to do that. That's a very painful place to be. So a lot of the process and this idea of enterprise risk and that type of thinking is to avoid needing to de-lever or de-risk, I should say, at an inopportune time. So, we just have some kind of points here. Again, I think investing in growth assets requires a long-term horizon. Most hospital systems, however, they're levered entities. So, whenever you face leverage, you're worried about a margin call, so to speak. So the key is making sure we can sustain market declines and not reduce the risk at following a sell-off. And some of the things we're going to look at are debt covenants, very important, obviously, that can threaten the going concern nature, even downgrades to the extent you want to maintain access to capital markets. And then unexpected cash needs to fund capital projects, operations. Puttable debt is another category here. I think especially now, as we've seen several presidential candidates start to talk about things like Medicare for all. It's been pretty good from a debt market standpoint. Hospitals are able to refinance fairly readily. But does that put pressure on the muni industry specific to healthcare? Across the industry, we see a really wide variance, not just in the financial metrics and payer mix, but also in goals and risk tolerance across hospital systems. I looked at our clients at Pavilion Mercer. We have some that are close to 75% in equities, so very much like an endowment, and others that are 100% fixed income. So they look more like insurance companies. That makes peer comparison difficult. You do need a great degree of nuance. One strategy is not more correct than the other. It really depends on your specific circumstance. And what we're about to talk about, what we are talking about, enterprise risk modeling, is just a way to get there. So with that background, I thought I would jump into, kind of our approach and the things we think about. I'll continue to move through this, and where I do want to spend more time again is on, we have a kind of a case study and get into some more real data that can kind of talk through some of the issues. But, at a high level, we call our enterprise risk model our CARE process, comprehensive analysis of risk exposure. The idea here is that on the bottom of the page, you have a number of risk factors facing you. There's interest rate risk. So from people worried about their cost of debt going up, you have swaps. Also the performance of assets, particularly those systems that have a pretty heavy allocation to fixed income. They're definitely going to have more exposure to interest rate risk. Now that's been a very good thing this year as rates have fallen, but at various points in time that might not be desirable. Bond covenants are really the big one, and where I think most people spend most of their time trying to crank out the algebra and test for bond covenants, still critically important. But, just that's really one of the more draconian views. Other things to be thinking about in this environment: unexpected large cash needs. This is, again, potentially thinking about what if the market for our variable rate demand notes dries up. What if, we no longer can get letters of credit to support those? If we're currently providing self-liquidity and there's a market crash, how are we going to step up and provide liquidity? Are we going to sell that from equities or from bonds? The planned expenditures across the board, we've certainly seen an increase in capital appetite, much higher than in past years. That again puts some pressure on the cash available for investments. And then for those still sponsoring pension defined benefit plans, the pension status volatility is a big one. And again, this is one that really rears its head in painful moments like we saw in the financial crisis, where not only did operating portfolios take a big hit on the asset side, pension plans did as well, and the discount rate shrank pretty dramatically. Now, we've seen discount rates fall precipitously this first 6 months, so even some of the best performing pension plans have really failed to make up funded status grounds. And then, in terms of how we can manage that, what's the overall equity exposure we have in various portfolios? How balanced are we to factor exposures, diversification, the asset duration exposure? Most people with DB plans are very familiar with asset liability modeling. And then the liquidity of investments, and we'll touch on this later on, particularly for those that are pursuing private capital strategies, where in a market sell-off, the denominator effect can really increase the allocation to illiquid assets, and obviously the key in illiquid assets is much harder to rebalance and much harder to raise cash from. What we show here on slide 12, these are just common investment pools we see across health systems. I think we're going to spend a little more time on operating portfolios today, but the idea again is most of our clients that we work with are multi-pooled. All of these pools really get integrated into the model that we have from a stress testing perspective. We're going to get to an example much later on of a system that has an operating pool, a foundation, a defined benefit plan, as well as an insurance business as well. So, we kind of show how we can bring those all together later on. Clearly, each of these has individual risks that can kind of bubble up from time to time and put pressure on the balance sheet. But again, the idea is to think about where, from a holistic standpoint, how do you want to take risk? Where do you want to take risk? And making sure that, when you have a big sell-off, it doesn't affect you in more knock-on ways than anticipated. The framework that, we try to bring to the table here, we like to look at the risk tolerance in terms of ability versus appetite. And when we think about ability, this is mostly going to come down to financial strength. How strong of a credit are you? How stable is your balance sheet, your margins? Clearly, those that are stronger are going to have a higher risk tolerance or a greater ability to take risk. The appetite for risk, boils down more towards the market conditions. And I think at this point in the cycle, we look across the board and it's just difficult. There's not a great ton of opportunities. The question I hate as an investment consultant the most right now is a client does a debt offering and they have a great deal of fresh money to invest, and they say, what should we do with it? It's just very difficult given how far the market's come recently to commit to equities. Even though you're a long-run investor, from a timing perspective, new money is really hard to do. It's a little bit easier when you already have money in the ground. But again, trying to balance your ability versus the appetite. We'll drive into those a little bit in terms of ability. Again, I talked a little bit about just the kind of strength of credit. The first big category at the top of this page, operating environment. I mean, this is really exogenous to our modeling. We have no influence there. Same really with the financial performance. The business, the underlying business is what it is in terms of operations. I think where we can really add value there is on stress testing some of those key metrics, particularly metrics that are influenced by investment performance, whether that be days cash on hand, debt to cap, or the debt service coverage. Capital spending, really been a major focus. I think we've seen across the board a lot more planned expenditure and also a lot more contingent or expenditure or just kind of strategic initiatives. So, how do we want to think about that in terms of budgeting and in terms of risk taking? We think here it's really helpful to look at a capital spending plan, kind of 5-year projections, and we'll look at an example of that later on. And then finally, the credit rating. Not every system we work with cares tremendously about the credit rating, but for others, it's significantly important, especially those that are maybe lower rated in the BBB category, and again, need to continue to be able to issue debt in the coming environment. The ability to take risk, I thought I would just create a toy example, just really high level here, I think just to kind of illustrate the key point. This is a fictitious scenario. We have a hospital system. All we know about them is they have 300 days cash on hand, and they have a debt covenant at 150 days. So on surface, they can lose 50% of their assets and remain above the debt covenant. In further discussions and revealing their strategic financial plan, in discussions with Treasury, we learned that their margins are expected to decline. They have a new competitor that's opening outpatient facilities and kind of picking off where they exist already. They have some strategic initiatives to try to combat that, including opening a new ambulatory center, and that's going to require outsized capital spending. They're going to be dipping into their portfolio. One of the things I think that's really grated on a lot of our clients is in this current environment, and for those with DB plans know what I'm talking about. Those that don't, be thankful, but the PBGC premiums right now for the Pension Benefit Guaranty Corporation, unfunded liabilities, you're paying effectively a 4% tax on that unfunded portion. So if you have a $100 million unfunded position, you have to pay $4 million just to those premiums, and that money just goes away. That's an expense. So, some of our clients have looked at that. If you think about from a capital, kind of a capital decision, we can invest in the pension, shore up the funded status, and really save. If you put $100 million to work, you can get a quote 4% return in terms of avoiding that expense. And how does that stack up against maybe other projects they're considering? And then the last item, just a conservatively thinking about, we have some VRDBs with credit support that'll be expiring. So the following page, again, this is highly simplistic. The numbers are made up, but when we look at this scenario where we thought we had the ability to lose 50%, when we drill down, we first of all, we back out, okay, what is the reserve for margin decline? They estimate that, look, our cash expenses, our burn rate is growing at a certain percent. In the next 5 years, we expect to lose about 35 days cash just based on that. From a strategic CapEx standpoint, this new facility they want to construct is 25 days, take that out. They do want to fund the pension. That's going to come out of their cash reserves or their operating portfolio. That's another 20 down, and then reserve for puttable debt's another 20. So where we end up, and we look at all these contingencies or what we expect, you go from 300 days to 200 days, and all of a sudden from a cushion, we only have 50 days. So, the idea here again is that we have dramatically lower risk tolerance than we initially expected. In terms of the appetite to take risk, I think fourth quarter was painful, seen a really good recovery in equities, particularly U.S. equities in the first 6 months of the year, even 7 months of the year. And fixed income rates have fallen pretty precipitously. On the upper right-hand chart, we show the Treasury yield curve at 630 or 331, and then at 628. It's just continued to fall. So, through the first 6 months of the year, appetite to take risk, if you did have some money that you're not invested, it's a really hard case to say, yes, let's go charging in. On the left-hand side, we show global equity valuations, fairly elevated relative to norms, particularly when you look at Shiller's PE, that's the CAPE, the cyclically adjusted price earnings ratio, higher than average. It's hard to make a case that equities are, quote, cheap. You sprinkle in talk about China and our trade war and see the volatility, equities are not particularly attractive and could give you some short-run heartburn. And then on the fixed income side, again, lower rates, I think we were making progress last year. The Fed was raising rates. All of a sudden, the short end of the yield curve became an investable place to be again. And for a lot of my healthcare system clients that need to maintain quite a bit in lower risk assets, finally, we can invest here. But the yield curve has continued to decline. We have inverted yield curve. Rates just keep going lower. So with new money again, lower expectations on a pure rate standpoint. And then in terms of spreads, again, pretty low, not all-time lows, but below, kind of near or below average, kind of on the lower end of the historical range in the investment grade category and even some of the non-investment grade category. This coupled with the fact that, there's been a big influx or a massive issuance of corporate bonds over recent years. I'm sure some of you have read that, triple B bonds used to be in the neighborhood of 35–40% of the investment grade bond in universe, and now they're over half. In the last decade, corporations have taken advantage of low rates, issued quite a bit of debt, and instead of taking care of leverage, or instead of trying to grow their business and maintain a certain leverage, increase their leverage to things like buyback stocks, which are really good for equities. But right now, the credit worthiness of the investment grade index is a little bit lower than it's been historically. So, no secret here, but this is just an idea of, thinking about appetite to take risk in the current environment. We issue new money. It's a hard case to say, even if we're strong credit, let's put a lot of money to work in equities right away. So what I'd like to do with the rest of our time, and then we'll conclude and I think have plenty of time for questions, is just go through what is pretty close to a document that I would go through with one of my clients and thinking through their current financial state. The first point we make and try to draw a picture of all the organization's investment portfolios. So this particular organization, they have total balance sheet assets. We'll say they're all included in days cash on hand, $2.5 billion. They range from, 80% of those are in their operating portfolio. They have an insurance plan that provides health insurance for their employees. They also have several commercial contracts locally. Those assets are at $400 million. In terms of investing these, there's really not a lot of leeway. They fall under insurance statutes. Their asset allocation is quite conservative. So not a lot of leeway here. It's more, again, exogenous to the process. And then they have a small foundation with $100 million. It's not a huge portion of their unrestricted assets, but it's an element there where they have a spending rate. They have to invest it, and they have a much smaller asset base. So they try to keep that portion of the portfolio fairly liquid and fairly simple. So the top half of this with the dark blue boxes, this is the area where I think most other consultants and, the easy back of the envelope, we can just do some basic days cash on hand and a drawdown, what happens. The bottom part of that page where we show a defined benefit plan of $2.2 billion and a DC plan of $1 billion. The key there is that the variability of contributions there will affect the overall risk tolerance. So when we look into this DB plan, some of the key takeaways on this one is that it's an open plan, so it continues to accrue liabilities. We need a long-term horizon there, and we do use illiquid strategies. There's no reason, they have no expectation of being able to close this plan or terminate the plan, so we do have some private equity investments there. And, the funded status at 88% at the end of the year, we have some ground to make up in terms of funded status. The DC plan, we show it in a dotted line. It really doesn't come into play much when we're thinking about asset allocation, but just reminding everybody in the room that there's this other obligation of retirement funding. In this case, that's $30 million a year is the employee match. We showed some of these earlier of, the range in various systems. Now, this particular health system is a AA credit, so they're very fortunate overall, in very good shape. we just try to show a picture of where they stack up in terms of various key ratios relative to worst, best, and median. So, you know, at a high level, their operating cash flow margin a little bit below, but fairly in line. Really strong days cash on hand, and that's a really solid part of the credit. There is a nuance and a wrinkle there when we look into their financial plan. We'll see in a moment, but that's strong. The cash to debt's strong. Debt to cap a little bit weaker, but fairly in line. And then average age of plant, they've been spending a lot on CapEx. It's something they like to highlight to Moody's in terms of they just have a younger plant and they want to get some reward for having spent money in the past on CapEx and likely needing to spend less in the future. Thinking about those financial metrics against AA systems, this is one module we have in our care process to look at credit rating risk. And what we've done, Moody's has a qualitative and a quantitative component. The qualitative component is going to focus more on how strong they think management is, the ability of, management to meet budget in the past. I think some of the credibility face-to-face in those meetings. But the quantitative criteria are spelled out in their methodology, and they really focus on 7 key ratios. And what we try to do is show the client of where they lie on each of these ratios. We do show the weight as well. So when you look at the top here, we have operating revenue. That's 25% of the weight. The trailing 3-year operating revenue growth is 10%, so on and so forth. So we show them where they lie on each of the metrics. You can see on balance, most of these, they're fitting comfortably in that AA category, which is what you would expect given their AA rating. And then at the bottom, we have this red dot line, and this says stressed. And for the ratios where the investments come into play, days cash on hand and the unrestricted cash and investments to total debt, we show the stressed view. So what we do in this case is, what is a down 2 standard deviation event across all the portfolios? How does that affect the financial picture of the health system, and where do they shake out? So for this client, even in a down 2 standard deviation event, they're kind of hanging on the bottom end of the AA rating. Keep in mind, if markets are down 2 standard deviations, these are all going to slide. Of course, most AA credits have a fair amount of equities. But again, it just gives a picture for how strong are we on the quantitative part. And again, the takeaway here is that pretty solid in terms of overall credit strength. This is kind of setting the stage. This is a system that historically had extremely robust operations. They were writing large checks every year into their operating portfolio, and they've really had their margins come under pressure. Some shifts in payer mix and competition. Their operating income has declined from a 9% margin to a 3% margin. They're trying to get back up to 5%. They don't expect better than that. And then because they do have a large portfolio and a large days cash on hand position, that's the good news. The challenge with that is when your portfolio becomes large relative to your operations, those portfolio investment returns, when they are volatile, they're going to have a pretty big effect on the overall net margin. Now, I know some systems don't care a great deal about net margin, but when your portfolio does begin to get larger, and if you see a big decline, you could be in a case where you're actually looking at a negative net margin. And again, it's kind of our point is to educate and make sure investment staff and our clients and committees are comfortable. One of the things we do, and this page can look different for a variety of clients, what are the key things we look at? When we look at the financial plan for an organization, these are just 5-year projections. One of our things is anybody can stress test the starting point. This is 12/31/18 was the starting point, and they were at 400 days cash on hand. In their first year, they were expecting some pretty considerable capital spending, so they're going to go from this 400 down to 370 days cash on hand. Our point with this is that we call that our stress year, and we want to conduct our stress tests based on that 370, not on the 400, especially given that some of that money is going to be going away, and we certainly can't count on that. This system, they don't plan to issue significant debt. It's more maintenance debt, but for other systems that are maybe thinking about a significant debt issuance a couple years out, that's an area where we might want to think about their kind of stress year is the year right before they issue debt. How painful would it be to have a negative environment, the year before or the year of a big debt issuance? Could that maybe impact their ability to issue debt? In this case, not really the case. They have a pretty low debt to cap. We think they can continue to borrow money. That was, again, a lot of this is, and my job when I first started working with a client is to listen and listen what they're concerned about, and what are their goals, and we try to distill it into a couple slides that are more committee friendly. When we think of debt structure, we look at it from a couple different angles. The first one is, what is your cost of capital and what is your interest rate risk exposure? And, by and large, the cost of capital, what's the weighted average cost of debt? We try to include the swap. So sometimes we work directly with Treasury on this. Sometimes we can get that easily from the financial advisor, whether it's a Kaufman Hall or a Ponder. Other times, we kind of back into it by just reading through the swap language. The thing we have here is they have a cost date at 3%. We have, if there's a finance committee involved or any business person, we want to make sure that we have a more than reasonable probability of outperforming that cost of debt with our investments. It's a good question that some committee members will have, is if we can't out-earn our cost of capital, why are we investing in the first place? The reality is, as we know, it can be harder to delever than you would expect, than it might entail. But again, just can we outperform that cost of debt? And then the other element is, what's your exposure to rising interest rates or, swaps? When I first started in this business 12 years ago, I would see all these variable rate debt, and I always assumed that there was a lot of exposure to interest rates. Most systems I work with have pretty significantly sized swap portfolios that hedge a pretty substantial portion of that interest rate risk. Now, it doesn't all flow through in the same part of the financial statement, but in terms of the net use of cash, this is, I would say, representative. We see at the top they have a total debt portfolio of $1.5 billion. Fixed is $1 billion, variable rates $500, and they have a swap portfolio that's roughly a 1-to-1 match at $400 million. So, from an education standpoint, again, when we sit in front of an investment committee, even if investment staff and Treasury and CFO know this, to be able to explain to the investment committee, look, we are not really concerned about rising short rates in the near term. In fact, it typically is going to help the swap portfolio and those marks. To the extent we have rising rates on the long end, if you have a DB plan, that would certainly be helpful. In this case, we're able to just say, look, you only have 7% interest rate exposure. It's about $100 million. And by the way, the effect on investment strategy on this side, we have a comment. They have $200 million in really balance sheet cash. If we invested that for some kind of yield and yields go up, that ends up being a natural hedge to the floating rate debt. The other element of debt consideration we focus on is event risk. So debt covenants are a big part of that. And then the other element are variable rate demand or puttable debt. So this client, pretty straightforward. They have this easy bogey of a days cash on hand debt covenant of 100 days. We show the current days cash on hand of 400, and even this stress year, which is what they projected at the end of this year, 2019, 370. Comfortable headroom. We would say that's not restrictive. The other observation, we look at kind of the ongoing annual principal payments, as well as any self-liquidity they provide on debt. They have daily and weekly modes, pretty modest amounts, a total of $150 million in potential debt service in a given year. And they have assets that are unrestricted liquidity that's daily available of 800. So considerable cushion here. We do work with some clients that have pretty strong days cash on hand, but they have a more aggressive debt structure and a large amount of puttable debt. And this ends up being a big part of our discussion in those cases. And it oftentimes can push down what looks like might be a pretty high risk tolerance, might make a particular health system a little less risk hungry from that respect. We mentioned at the top, this particular client had a defined benefit plan, high level, $2.5 billion liability, assets at $2.2 billion. So a whole of $300 million, a funded status of 88%. The effect on investment strategy, we're going to need to continue to take risk in the pension plan. So we're going to have considerable use of equities. We're going to use illiquids as well. And so there will be funded status volatility. There's really no getting around that. We're going to have to bring that together. I think where possible, more and more clients, especially as they get close to fully funded, have a glide path in place, maybe look to terminate and take this chip off the table. In this case, I think it's a more interesting example because it still is on the table. We also comment that there's a glide path in place. Again, a lot of this is just re-education for the committee. Oftentimes these topics are handled in different meetings, but reminding everyone there's a glide path. Our current interest rate hedge ratio about 40%. So again, if we do see runaway inflation and we do see higher long rates, that would be a tremendous help from a funded status perspective, not something we're necessarily concerned about. The next page, we talk about required return considerations. And one thing I would say the investment consulting industry, and I would say I was guilty of this too, I think we were really good at focusing on downside risk coming out of the crisis, 2008 and early 2009 were just so painful. We spent so much time on downside risk and so many scenarios on downside risk, but one of the things we need to keep in mind are, okay, we do need to earn return, and what are the various quote required returns or just kind of hurdle returns. We talked about the cost of debt at 3%. That I showed you a financial plan early on, and that included a budgeted rate of return of 5%. So again, we need to earn 5% to make the plan work. If we fall short of that, if we de-risk and go to cash, the strategic financial plan really doesn't make sense. They would have to re-rate that. Projected days cash would be much lower looking out in the future. And then finally, the cash expense growth. In an environment where we continue to see that excess cash flow get compressed, and we see smaller and smaller additions to the portfolio, we start to think about the portfolio as a closed system, and the need to maintain. Let's say there's no contributions to the portfolio, and we have cash expenses growing at 6%. We need to hit that target just to maintain current days cash on hand. So these are considerations. We don't necessarily think shooting for one or the other is paramount, but these are things we should keep in the back of our mind as we go through our analysis. The other thing we show on this page on the upper right-hand side, we talk about net financial margin. This is, again, thinking about the spread of investments to debt. So we have a total investment portfolio. We expect to earn a 5% return. We know there's a lot of volatility there, but that's the long-term expected return. And then we have total debt of $1.5 billion and a 3% cost of debt. So what we see here is we have a positive margin in terms of investable assets to debt. We have a positive spread in terms of the return, and then a positive dollar spread. And again, oftentimes this is helpful for just framing, what the investment program brings to the organization on an expected basis. And again, this is an annual figure. One of the things our model allows us to do, and again, the model is always a challenge because it ends up looking like a black box to clients, and it ends up looking like a black box on this call. Below all these pictures is a model, and you're able to toggle a bunch of different things. But one of the things we're able to do is to vary investment returns, which has really always been the purview of an investment consultant. But to think about, what would happen if we had a change in projected EBITDA margin? So in this case, for their projections, they have a base case of 9% EBITDA margin, and we expect a 5% return. And then we look at, okay, what are the sensitivities if we fall short that margin by 1%? We're only an 8% EBITDA company. What does that days cash look like in 5 years, even if we were in the 5%? It's 20 days lower. And then we show kind of a heat map here where, what cases, what scenarios do we stay over 400 days? Where do we fall under 300? And you can see, obviously, if we have over 5 years, if we annualize less than 0, we're likely to be under 300 days cash on hand, particularly if we see continued cash flow margin erosion. Oftentimes, in terms of what's more sensitive, I would say most of my clients are more sensitive to a percentage shift in EBITDA margin. But however, one of the things for clients with a really large portfolio and really large days cash on hand, they do have, with the bigger portfolio, one of the negatives is they're very sensitive to changes in rates. So, a larger system with a very large portfolio will feel it pretty acutely if their portfolio fails in terms of their ending days cash on hand. Kind of punchline here, we showed early on we listed all these portfolios that the client had, and we talked about how their actual days cash on hand at the end of 2018 was 400. We budgeted this stress year of 370, and you know, just what they had planned on spending in CapEx and what we'd likely end the year at 370. And then what we do is we shock using, they wanted to use a calendar year 2008 scenario. And again, this hit all the portfolios. So a big loss in the operating portfolio, pretty large loss in the foundation. The insurance assets were a little less scathed because it was all fixed income. And then keeping in mind we have a DB pension plan. You know, we started off at 88% funded. One of the goals again was to they wanted to see what does it look like if we fund the plan back to 80%. So we looked at what's going to happen to the assets in the pension in 2008. We also increased the liability a little bit for falling rates, which we've already experienced the falling rate. But you know, pension funded status decline. What does it look like if we get back to an 80% funded? And why that's important is it allows the plan sponsor to continue to make unrestricted lump sums and offers, et cetera. So what does the 2008 scenario look like across all the portfolios? And then assuming we have to fund the pension plan, which costs them another 20 days, and then where's that debt covenant? So in this case, you know, the risk tolerance, you know, we're very comfortable where we currently were. Client wasn't looking to take an extreme amount of risk. But the one, you know, the two concerns they did have at this point was, one, they have 20% in illiquid assets. How's that going to look? And then the other element was they had a couple members of their committee that were considering de-risking, wanted to take more risk off the table. So for the first item, liquidity stress event, what we try to do here is create a pretty draconian stress event. So in this example, the starting illiquid assets at 20%. We took the entire portfolio through the 2008 scenario. And then we assumed all uncalled commitments for the illiquid assets were called immediately following. So again, very unrealistic. That's not what happened in the financial crisis. But if that were to happen, they go from 20% to about a third of their assets in illiquids. This was, you know, from their standpoint, it gave them comfort that they could manage at this 20% level, but it also gave them stronger conviction they didn't want to exceed that 20% level. The other challenge they had was thinking about de-risking. And what we show here is we kind of show their current portfolio. The expected return at the time was 6.5%. I think more recent capital market assumptions are less favorable, but again, just thinking about directionally what we're looking at. You know, they had a committee member that did not want to go below 300 days. And so our goal here was to look at their current portfolio, and then a sample more aggressive portfolio, and then two less aggressive portfolios with lower return, lower standard deviation. And then we looked at, okay, what would days cash on hand look like in the stress year of 2019? And then what we have here is the different, you know, these are up 1, up 2 standard deviation, and down 1 and down 2 standard deviation events. They're currently here in the 6.5% portfolio. If they wanted to protect and maintain their days cash on hand at the 300-day level, they'd be somewhere between a 5 and a 6% expected return portfolio. So, you know, we can do that for them, but what's the give up? And I think what we look at here, which was very helpful in this case, is what is the projected days cash on hand 5 years from now? And you can see, again, in moving from this 6.5% portfolio to the 5% portfolio, you do protect on the downside. You're in a down 2 standard deviation event, you're 35 days cash on hand better off. But look at the upside you give up, you know, to the tune of relative to where they're at. In an up 2 standard deviation event, they're giving up 140 days cash on hand upside. You know, even at any of these break points, it's the same story. The expected give up is quite high. So again, going back to what I mentioned earlier, in the past, I think consultants have been very good about looking at the downside considerations, but one of the things we also need to do is challenge, kind of resist the need or the desire to become very conservative and potentially miss upside that would greatly benefit the balance sheet. The last slide that I wanted to come back to here, again, this particular client had experienced a decline in operating income, and their portfolios maintained a pretty large size. And when we just ran through, we looked at their operating income for 2018 of $70 million. And then we did what would happen to your investment portfolio in the base case. So base case, it's up 150. You get a total kind of net margin of 220. We excluded some other minor elements just for sake of analysis. And then what happens in the one or two, down two standard deviation event, you can see that net margin. Wow, I mean, their portfolio could lose over $300 million and they could show a net margin of down $250 million. Again, this didn't influence them to get more conservative, but again, it was about understanding those, that potential impact. Thankfully, they care a lot more about the operating income than the net margin, but again, it was something that they found useful. So with that, I think right on time concluding kind of the prepared remarks, 15 minutes at this point for any questions that I'd be happy to take.
Okay, great. Yeah, if you want to ask a question, please type them in there in the box. We have one that came in a second ago. How has enterprise risk modeling evolved over the last decade?
That's a great question. I think, the big picture, I kind of alluded to it in my presentation, was I think we've gone from just a balance sheet focus on days cash on hand and running it through a downside stress test. One of the things we've been able to do is to do more what ifs. One, through our model, we're able to load 5 years in projections, but then to think about what ifs in terms of, okay, what if margins decline and we see, a negative market environment? What does that do to our key ratios? What if we decide we're tired of this pension plan, we want to fund this up and terminate the plan, we're going to spend money out of our operating portfolio. If we do that, how does that affect our ability to take risk in the operating portfolio? We know we'll have a smaller absolute base of assets and our days cash on hand. Do we also have to reduce the risk then because we're closer to debt covenants? So I think the what ifs are really the key to evolution, and the key to, at this point right now, where I think even 5 years ago, most of my clients always had a pretty detailed 5-year or 7-year capital spending plan. Whether or not you make the plan was always a question, but people had projections, and I feel increasingly with some of my clients, there's just so much up in the air, whether it's strategic combinations or even kind of entering some different businesses. It's hard to have really detailed financial projections. So the what ifs have been, I think, more value in terms of discussion with clients.
Okay, Chris, there's another one. Do you see any trends in health systems taking on more or less risk in the current environment? How are they using their liquidity budget?
Yeah, I'll start with the last part, the liquidity budget. I think, increasingly we've seen more of a barbell approach. I think going back after the financial crisis, I think a lot of systems were, maybe 20, 25, 30% of their portfolio were in that less liquid bucket, hedge fund strategies, fund of funds. We've seen that really decline in a barbell in terms of favoring traditional assets as well as allocations to private equity and private debt. So, we've seen a barbell there in terms of how liquidity budget is spent. And then in terms of the trends for more or less risk taking, that's been all over the place. We've had, I'd say on the margin, it's either staying pat to slightly less risk. There is one client I work with was downgraded at the beginning of the year. They've come under pretty intense financial and competitive pressure. And in that case, we were talking about maybe taking risk off the table. 2018 was painful. And then we were kind of gifted that really strong first quarter. And, we changed them from basically we went from more of a 60-40 to a 50-50 portfolio. So still, a decent exposure to equity markets. And that certainly helped in the second quarter, but took some risk off the table. But, really no strong trend. I think it really just depends. I think we looked at the top of this presentation and saw the wide variance of, financial strength across systems. And it really is more on a system by system basis.
Okay, how frequently do health systems revisit their asset allocations through an enterprise risk analysis?
So if we've never worked with this, if it's a new engagement and I've never worked with them, I think it's one of the items on the work plan we want to accelerate and have done sooner than later. I think, it depends on, client to client, but every 2 to 3 years to do more of a full study seems to make sense. Obviously, accelerating that if something significant occurs, if there is a downgrade, if, system decides to change strategy in some way, if, again, they really want to take a deep look at maybe getting rid of a pension plan or take a look at some large capital projects and spending out of their long-term investment pool, it would be worth looking at just on that basis.
Here's another question. How do you engage clients in this type of analysis? Who from the health system is involved? How are the findings communicated to investment committees?
Yeah, whenever we begin one of these, and my background was in business valuation, so I've done a lot of financial modeling, and I had a heavy hand in building our model. I always approach it quite humbly in that, anyone I'm working with from an operating company, I don't know that much about their business. I mean, I try to do my homework. I read audited financials, any investment rating agency reports out there. I come as prepared as possible, but it really begins with the Treasury Group, CFO, anyone in the finance area. And I think it's just crucial. I mean, my first job, start these discussions, is to listen. What are they most concerned about? What are their goals? Someone's goal might be like, look, I really want out of the defined benefit plan. Someone else's goal says, look, we want to just reduce the volatility around the defined benefit plan, and we want to increase the corpus of our portfolio to be able to kind of support operations like a foundation or endowment down the road. So really a lot of listening and talking to finance. Long before we, even get in front of a committee, I'll run through a presentation like this using the client's actual data and our findings and full modeling and all the asset allocation recommendations, usually 2 to 3 times. And then oftentimes at the client's discretion, maybe they want to bring in their investment committee chair or finance committee chair. The idea is to kind of get everyone on the same page on the consulting side, on the staff, the treasury side at the health system before it hits the light of day in front of the committee. The experience that I've had in receiving this from committees, I think is useful in a couple cases. I think there's some hesitancy to bring it in front of the investment committee in a detailed level because they don't necessarily want the investment committee so ingrained or thinking about operations given their purview. But, I think 2 challenging elements are if you work with a health system that's maybe more challenged and has some debt covenants that are concerning, they have to have a more conservative posture, and they end up with somebody on their investment committee who also serves on like the local university endowment. They might be more accustomed to seeing a 70-30 portfolio and seeing 40% in private equity. We think our analysis really helps sell and provide, good cover for not taking that level of risk. And then alternatively, I think sometimes you have board members that they want to do the best thing for the organization. It's not their money. They're maybe more risk averse than they would be with their own money. And being able to show them some charts on, look, we want to continue to sustain the balance sheet. We want to invest for growth. We can maybe show them that chart I looked at prior, this one here, where kind of show them the lost upside. So, I look at it as more of an education tool and really to try to get buy-in. And then, once people, I think, are educated on this and walk away with this, particularly if you look quite a bit different than a 60-40 portfolio, let's say you're 20% equities, 80% bonds, it's important that board members understand why, and, the committee is really comfortable with why that's the case. Or alternatively, if you do look more like an endowment, being able to have comfort that that asset allocation is appropriate.
Okay, we got a final question here. Essentially, they're asking, will the presentation be available afterwards, including the commentary? And I'd like to tell everyone we did record the presentation, and it will be posted online tomorrow, and I'll send the link to everyone who registered as soon as it's posted online. Chris, I think that's all the questions for today.
Well, great. Thank you for your time, everyone. I hope you found this useful.
Yeah, thank you, Chris. We really appreciate it. A great presentation. Thank you.
Thank you, everyone.